are once again welcoming Gary Kleiman, who is a BSFS alum that has had a very long practice of his own in doing emerging markets analytical work and being a very significant advisor to groups of both private and public sector decision makers, individuals that frame their daily work and understanding through the lens of what is happening globally. And one of the things that makes Gary particularly engaging for us is that the quality of his presentation is very storytelling-like. And that's one of the things that I really appreciate. You can really connect to what's happening from that lens of story. And we'll see that a little bit in the workshop come to life. We have been in cahoots talking about prospective offering beginning next year to teach you how to create these types of narratives and research that is connecting to the work in emerging markets and financial markets in particular. So I'm going to hand it over to Gary. This is a two-part program. For those of you that are registered for both parts, we'll do the presentation and then we'll open up to Q&A. And somewhere around 1:30, we'll transition into the workshop. Please feel free to get up, grab some food, and restrooms, for those of you that are new to Mortara, are just right over here on my left if you need to access those. But other than that, any questions about logistics or? No? Very good. Well, thank you again for joining us. Gary, thank you again for coming to campus.
Yeah, thanks. I'm going to ask, is it easier for me to stand at the podium? Can you see and hear better? Okay. I'll do that then. And Rosie was kind enough to promote my firm a bit, but if you want to know a little more, go to the website, KleimanInternational.com. You can Google me or my firm. You'll see a lot of other writing. We've been an independent analyst of emerging financial markets and economies for 30 years. I started my firm with someone who knew how to actually run the business side in 1987, just a few years out of Georgetown, before really, or coincident with the coining of the term emerging markets, but before it really existed as a field, and certainly as a separate industry of analysis, which is what we're trying to emphasize and is what we're hoping to cultivate through the IBD program, as whether it's in terms of training or study or ongoing projects. So the more that you can beard Rosie and other colleagues in the program, the more likelihood we have of maybe developing this type of offering. But what I'm going to do today is basically go through this order. Well, maybe I'll use the other. What happened here? We already lost it. Okay. Yeah, just use the clicker. It's probably easier. Okay. Okay. And I think it's very appropriate, perhaps, that the weather is scorching outside, because certainly if you followed emerging markets at all last year, you know the performance was very hot, unexpectedly, as it is in February. But basically what I'm going to try to do in a half hour, 45 minutes, to leave plenty of time for questions and interaction, is look a little bit about what happened last year in terms of index performance and fund flows in stock and bond markets. Look at global factors perhaps driving that result. And the argument that you should take away is perhaps for the past 5+ years, because emerging markets have more or less been down, both debt and equity, their result was basically derived from what was happening in industrial markets, and particularly in terms of the global liquidity cycle pushed by central banks. The last year was probably the first time you actually had a pull from emerging markets that they have yet to build on. But the story aligned very nicely in a positive fashion as opposed to just being an escape from the industrial world, a negative sort of push phenomenon. And then we'll look at what were the economic underpinnings in emerging markets that were favorable. Then we'll look a little bit at stock and bond markets, break them down in detail as to why they did so well. Then we'll go through all the regions of the world very quickly. Latin America, Europe, Asia, core emerging markets, as well as Middle East, Africa, what we call frontier. Then we'll draw some conclusions as to what the near-term outlook and also the medium-term signals might be, because that's of interest to you probably from both your classroom and academic perspectives, as well as your professional ambition. And again, if you have any questions, I wish I had time to open the floor so you could all introduce yourselves and tell me a little bit about what you're interested in. Hopefully we'll have time to do that a little at the workshop. But feel free to interrupt me at any time. And I will in turn as well call on you perhaps, because I know that you have some expertise and you might have some of these answers, and so I don't have to repeat perhaps the obvious. But just looking at the first category, the record performance from last year, what was unusual about it is that it was homogeneous. It was across the board. Every category of equities, and we divide equities in both sort of core emerging markets and frontier, all debt asset classes, that's local government debt, external government debt, external corporate debt, was up a good double-digit pace, led by stock markets for the first time. Stock markets, the core emerging market index was up 35%. And every component within these categories, every country, every corporation was also up, almost in lockstep. Now, you probably don't have to be an investment genius to realize that that's very unusual. And can you guess maybe the last time that that happened? When we had such an emerging market euphoria? It was right before the global financial crisis in 2007, 2008. So that in itself might provide a little caution and warning. And when we look at the fund flow data, there are ways you can get industry data through various sources. The best known is EPFR. And also you have sort of the macro aggregate data that you get from the Institute from International Finance and other providers. If you look at the macro data from the Institute of International Finance, they'll tell you that for the first time last year we had net portfolio inflows into emerging markets. That is, often with emerging markets, what comes in also goes out in terms of investment in US Treasuries, in terms of outward direct investment and the like. And you had about $1 trillion come in across the board, divided half into foreign direct and the other half into banking and portfolio investment flows. That's debt and equity. When you look at the industry composition, you're looking here at mutual funds that are, some are dedicated to emerging markets, some are global mutual funds. You see the different debt and equity readings in the blue and the orange. Here, going back to 2015, you had about $100 billion negative. Then it moves up marginally, and then that was the time of the taper tantrum, if you remember, when we had the Fragile Five and flight from emerging markets and worry about current account deficits and the like. Then in 2016, we moved marginally up again. Debt is always in the lead. Debt flows. We're in a global debt boom the past 10, 20 years. Then last year, you see it's almost even. And look at the number, $200 billion into emerging markets. And then look what happens at the beginning of this year, which we'll return to sort of at the end when we conclude. For the first time, equity, which happened to do better than any other asset class last year, is in the lead over debt flows through the month of January. That hasn't happened in the past 5 years. So we see what happened in terms of fund flows a bit, in terms of the indices. So let's look at what the overall global push and pull factors may have been. And a lot of these you know. You have interest rates starting to rise marginally, really for the first time in the better part of the decade. But we've really hit bottom in terms of sort of the central bank liquidity creation through quantitative easing and the like. And as you see at the beginning of this year, the market is starting to demand higher interest rates, whether it's through growth that we'll get to in the next heading, or whether they're starting to worry that maybe interest rates have been too low for too long. Central banks have their foot off the pedal a little bit. So with the expectation going forward, particularly when we look at the fiscal side in a minute, might be that interest rates are heading higher regardless of higher growth. But for now, the rationalization very much is we're in a synchronized growth recovery. That is, every market, here again we have sort of the homogeneity that's very unusual. For the first time since the financial crisis, not only industrial economies are recovering and emerging economies are doing better overall, but almost every emerging economy is registering very healthy growth. If you remember, it was only about a year or two we were really worried about some of the larger emerging economies, in particular the BRICS, like Russia and Brazil. They were all in recession, actually. And if you look back at the past pattern, the expectation of growth, and we'll get into this in the workshop a little bit more as well, was 7-8%. Obviously, we haven't seen anywhere near those growth numbers outside China and a few other exceptions the past few years. But we sort of see this, again, all emerging markets rising, registering healthy growth that's predicted about 5%, we'll get to in a subsequent slide. And as interest rates are rising globally, also fiscal policy in turn is easing. For the past 5 to 10 years, austerity has sort of been the watchword, even though we'll find out in a minute that emerging markets have been running some fiscal deficits. In the industrial world, you know, there's been a lot of austerity policies, but we haven't sort of primed the pump and loosened the purse strings altogether, but certainly we're much looser. Fiscal balance is not that important, and particularly since monetary policy is sort of incrementally tightening, fiscal policy can ease as an offset. And then we have the changes in currency, commodities, and credit ratings the past year. Remember at the beginning of last year, we were worried about the almighty dollar for whatever reason. The dollar was sort of dominant against other industrial currencies as well as emerging markets. That trend is almost completely reversed over the past 6 months in particular. Every emerging market currency is up pretty healthily against the dollar. That's for a variety of underlying fundamentals, but also the perception that the dollar should be weaker for whatever reason when you look at the current account, when you look at politics and the like. The commodity complex has also rebounded. Remember, commodity prices were really tanking 2 to 3 years ago. A lot of worry about Chinese demand in particular, but it hasn't come back as it was in the past with the super cycle. There's very much a division within the type of commodity. That is, oil has come back a little, but nowhere near the boom times, the $100, $120 a barrel pattern of past years. Agriculture has not risen as much as industrial and precious metals, so there's really a differentiation within the commodities. Credit ratings too. The credit rating trend overwhelmingly the past few years has been way more downgrades than upgrades, both for sovereigns, that is the government side, and corporates. Now the margin is narrowed a lot. They're almost even. There's still more net downgrades than upgrades, but you know, you see some upgrades all the time in the sovereign space, whether it was Indonesia and others, and you see the corporates basically plateauing in terms of the downgrades. Now that should tell you, even though you have plateauing in that pattern, that if you have downgrades, that you should be more careful about the corporate credit. But again, everything is booming. No one's really paying much attention. And that's an underlying message we'll get to again. Volatility. We've been in a very low volatility environment. Whenever there was any sort of surprise or brief correction, it automatically reverted. If there was a decline, people would so-called buy the dip, whether it was in stocks or bonds. So we really didn't see a lot of fluctuation in asset prices. But that is obviously changing a lot the past few months. You've seen a lot of volatility, particularly the past few weeks. And some of that is driven by the underlying asset class rotation from debt to equity globally that we've been talking about for a long time, for the past half a decade, but is finally starting to take place. And you see it in emerging markets. You see, remember, more inflows into equity than debt for the first time. Stocks are starting to converge with bonds. That doesn't mean that investors are abandoning bonds. That just means they're balancing more. The politics and geopolitics we can talk about a little bit, but in terms of the political side, sort of the fear of populism that was sort of raging globally, again, has sort of reached an end point or at least a respite, particularly focused on Europe. And the geopolitics that we worry about in terms of confrontation, again, the Middle East, Asia, and the like, they're still out there. And I would mention here again, sort of global pressures, whether it's refugees and migration or the environment. It's sort of in a static pattern right now. It hasn't gotten better, it hasn't gotten worse. So it's not on investors' radar screen as a major concern. And finally, at the beginning of the Trump administration in particular, and we still have this concern, we were worried about, we knew that the Trans-Pacific Partnership was going to be abandoned. We worried about NAFTA dissolving. We worried about sort of the whole global trade regime foundering. And you can argue that it has to a certain extent. Obviously, NAFTA is going to be changed. But there's also a good news story in that the TPP is being reconstituted without the U.S. And there are a lot of other arrangements. If you notice, even the Mexicans have said, well, we're going to really pay a lot of attention to forging more bilateral and multilateral trade agreements outside the U.S. with other emerging markets in particular, if you look at places like the Pacific Alliance. So this is a very good, this is a fundamental story for emerging markets going into the future. And the major part of the architecture that's really been redesigned favorably for the global emerging economies is what China is doing. You have the Asia Infrastructure Bank. They've taken the lead in sort of developing the BRICS new development bank and also a contingency facility to support foreign exchange reserves. But it's the Belt and Road, which is really a big positive driver. If you look almost in every emerging market outside Europe or Latin America, it's a major consideration for investors. What is happening in terms of infrastructure with the Chinese aid? What is happening in terms of lending? Because that relates to the overall indebtedness of emerging markets. But again, it's seen as a very much net positive, regardless of the U.S. withdrawing from TPP or perhaps taking tougher action against Asian and other partners, and also perhaps the succession that we're finding in existing arrangements over the past 25 years. Any questions so far? All right. So when we look at the economy in particular, again, we talked about GDP growth. Here you look at a rapid increase from about 4.4 to 5 over the past few years. But again, the trend is very positive. Although, if you look at the difference between advanced and emerging economies, basically the distinction is constant. 2 to 2 to 5 is about 2.8. So again, you're looking at a difference in growth of about 2 to 3% with industrial markets. Yet you're reaching sort of the 5% threshold, which is sort of the minimal expectation of emerging markets classically that we'll talk about a lot more in the workshop. And the sources of GDP growth are different to a certain extent. Traditionally, emerging markets have been very reliant on exports, and trade certainly recovered last year to about 4 to 5% growth, where it had been really in difficulty the past few years. But the sources of growth are very different too. There's a lot going into domestic demand in terms of infrastructure development, private investment spending, consumer borrowing, lending as well, and we'll talk about how that's supported by the banking system. So again, it's balancing the domestic and external sources of demand, which is very important and an investor consideration. Fiscal monetary policies, well, of course, with higher growth, we also have the expectation of at least marginally higher inflation in emerging markets. We're talking about maybe a 3% inflation rate, so you're talking a net growth rate of about 2%. But look at the sources of that inflation. Traditionally, they've been commodity driven. We're looking at sort of other sources of inflation, which can be actual growth, but it can be liquidity creation in emerging markets in particular. Because when we look at monetary policy, the sort of the hidden message of emerging markets the past year have been that fiscal and monetary policy has been very loose in emerging markets too. They've run deficits that are about 3% of GDP. They've kept interest rates pretty low, aside from a few currencies that have come under attack, like in South Africa, like in Turkey, like in Mexico. They kept interest rates very, very low. And structurally, if you're looking at structural changes, we have a few stories that are very well known, like India, Saudi Arabia, but basically we're not talking about regime change in terms of structural adjustment. We're talking very marginal changes. If you look at the rankings of the doing business or other measures or privatization or deregulation, it's very marginal. There's a lot more that can be done on the structural side in terms of changing the model and boosting near-term growth. And I want to talk a little bit about banking and non-banking, because that is really an Achilles heel that's underappreciated in emerging markets. Remember I said that domestic demand had been really a new departure for the sources of growth the past year or two. But a lot of this is done through domestic credit creation, often by still state banks. Credit growth is very, very high in emerging markets. If you're looking at growth rates of 5% or so, credit creation in emerging markets is 10 to 15%. And of course, in places like China, it's way out of control. They're going about 15 to 20%. So you know that that's not going to last too long. And a lot of that is not only coming from the traditional banking system, but really a ream of non-banks that have developed. And we see this really most clearly in China, where you have not only the banks, but so-called the shadow banks, whether it's wealth management products, investment trusts, all sorts of other permutations. But this is happening in emerging markets generally. You have other credit providers that are not banks, that are not regulated very well. You have insurers and others jumping into the mix, lending a lot. And this is part of the deliberate growth strategy too. But you have to keep your eye on it, because you can't have credit growth outpacing economic growth for too long without an accident. And obviously it's going to contribute to higher inflation regardless of what happens with food and fuel prices. On the external side, remember we were worrying a few years ago about the current account, the fragile five. Again, the deficits have not gone away in places like India and Turkey, but they're basically on a constant pattern. They haven't gotten better or worse. But the capital account, and remember the current account also not only is trade in goods, but its services, its remittances as well. Remittances have also rebounded a bit from the Gulf and other sources. And in the capital account, we've had FDI that's held up pretty well in the past few years regardless. But remember, we talked about the aggregate portfolio flows really jumping dramatically the past year. So the overall balance of payments has improved a lot. Reserves are accumulating again. We were bleeding reserves the past few years, particularly with the strength of the dollar in dollar-adjusted terms. And so that supports the exchange rates over time. And also in terms of the capital account, what's very important to know in the case of certain large reserve countries like China and the Gulf is that they have policies in place to bolster their reserves. With China, basically they've prevented capital outflows through outward investment, through tight controls on capital coming in and out. And for a Gulf country like Saudi Arabia that all of a sudden saw its pile of 600 billion plus draining, they've gone out and borrowed themselves, which is what we're going to get to in the next slide, to bolstering their reserves. So again, the overall narrative is you have reserves that are steady, and you have exchange rates that are supported from a balance of payments perspective. Any questions? Sure.
I had a quick question.
Oh, let me go back for you.
Actually, the slide before.
Oh, okay.
Regarding the credit rating shifts, is it possible that these are just still kind of the responses to overrated assets and commodities during the global financial crisis?
Well, the ratings have been declining since the global financial crisis. But the ratio, what's important is that you notice the overall trend is more downgrades than upgrades. That started around the time of the financial crisis, and that went for industrial countries too. All of Europe, remember, went from investment grade, top, AAA rated, to going to junk status. Now basically the two have converged. So you have not as many downgrades, you have not as many upgrades as downgrades, but you still have net more downgrades. But it's almost evened out. But that should tell you that you should be careful when you're picking and choosing, whether it's a government or whether it's a company. If you're still having more downgrades than upgrades, then everything shouldn't be going up simultaneously. You should be a little more circumspect in your allocation. Okay? All right. So let's get into the financial markets a little bit. And I don't know how much you're schooled in these various indices, and stop me if we get too technical or jargon loaded. But remember, we said we have two different types of indices for stock markets. You have the core emerging market index, and you have a frontier emerging market index. It's about the same number of countries, 25 countries or so in each. In the frontier, it's very heavily Africa, Europe, the Gulf as well. But again, both these indices went up almost the same amount, 35%. And every component went up. Obviously, there was some variation, but there were no losers. And the big story for the core index, in addition to sort of just a general mania, is you had China A shares added to the index. These are locally accessible on the Shanghai Stock Exchange that didn't really allow foreign investors, and you still have restrictions in place. But MSCI decided to add them marginally. China is the biggest component. If you count China and Hong Kong, it's about a 25% weighting in the MSCI core index as it stands now. So obviously, you're going to have a big position in China, or look at that as a big consideration. You add A shares, you're going to follow the index. China's going to do better. It's going to lift the rest of the index in turn. And the expectation is after adding a marginal amount of China A shares, about 1 to 2%, you could add all of them in index terms. So China could end up being half the emerging markets core index over the next 3 to 5 years. Valuations in emerging markets. Again, there's a justification for the 35% rise. That corporate earnings were very good last year, again, coming off a very low base. You had corporate earnings rise 20 to 25% on average in emerging markets. What you look at in terms of valuations, price to earnings ratios, still at a discount to the industrial world, and still fairly reasonable on an historical basis. Maybe 12, they started out the beginning of the year, moved up to 15. At the same time, the US is moving, beyond 20 in terms of the PE ratios. Exchange traded funds, I want to mention that as something to keep your eye on. When we started emerging markets, and particularly before the global financial crisis, ETFs really weren't a factor in investment. And they've come not only to be a major consideration, but take an increasing share of fund flows. Remember the first slide, the fund flows into debt and equity. Well, into equity now, about 25% of fund flows come through exchange-traded funds. Exchange-traded funds are very specialized. They trade on the exchange. They appeal to retail investors in particular, who may not be as sophisticated, who may be prone to panic. And there are all sorts of technical reasons that when you adjust ETFs at the beginning or the end of the day, you can create a lot of unnecessary volatility and losses. And ETFs have never really been tested in a crisis. We've never really seen what happens if there's a panic, how they can exacerbate it. So again, the rise of ETFs, the rise of retail investors, average retail investors. I don't know whether your parents have 401ks, maybe you have a college savings plan that allows you to have some emerging market exposure, but you have a lot of this population in ETFs now. And then finally, you have sort of a global tech cycle that was booming last year. Every kind of tech company went up. And what's interesting about emerging markets in terms of the types of companies, when we think about it sort of stereotypically, we say, well, you have cement companies, you have banks, right? You don't think of sort of the consumer, the high tech. The technical, in the technical category now, writ large, is about a third of the emerging market core universe, from basically zero at the outset when we started 30 years ago. So that's very important. So the tech cycle lifted a lot of emerging markets generally. Turning to bonds, we have local bonds and we have hard currency dollar-denominated or euro-denominated bonds. The respective indices are these are all JP Morgan created benchmarks. You have what's called the GBI, that's the local government bonds, and then you have the MB, Emerging Market Bond Index for sovereign bonds externally, and you have the CEMBI or SEMBI for corporate external emerging markets. So you have basically three different types of indices. But again, they all went up pretty much the same, on average about 12 to 15%, and they all hit records. The yield for local currency bonds fell to 6% on average, which hasn't been seen again since 2007, but it's still a huge pickup on what you can get from a treasury bond, right? At last year, 2 to 2.5%. And on the external bond side, both the sovereign and corporate reached records in terms of issuance. You had several $100 billion issued from new sovereigns coming into the class, including, like I mentioned, Saudi Arabia. Argentina, remember, was shut out of markets just a few years ago. All these countries are now arriving and pushing up the aggregate numbers, and they're good credit stories, perhaps overall. And then you have the corporates. And what's interesting is that you don't realize we tend to think of emerging markets in terms of countries. But it's actually the corporate category dominating. You had about $200 billion in gross issuance on the sovereign side. You had $500 billion in corporate. But here's the nasty secret. A lot of the corporates are what we call also quasi-sovereigns. They're owned by the state or they're controlled by the state, whether it's an oil company like Petrobras, whether it's a bank. So again, you should be careful, you should be wary. It's really an artificial distinction. But again, the issuance reached records. The spreads, the way we measure risk on these indices, on the sovereign EMBI, fell to 300 basis points over treasuries. The corporate even more. It's around 200 basis points over treasuries. Again, these are peaks we haven't seen for a decade. And the investor base is changing a lot, but again, provides a lot of potential vulnerability. Foreign investors are now the biggest owners of local debt almost across the board in every major emerging market. They own about 30 to 40% because, again, they're looking for places to put their money. And if you want to play the currency appreciation aspect, obviously you want to go into local denominated assets as opposed to foreign denominated ones. So this is a big vulnerability in places like Hungary, Poland, Peru. Foreigners own 50% of the local debt market, and should they decide to go, there is no local debt market, there is no local investor backup, really, to provide a rescue. But the investor base is also shifting in terms of the external side in an interesting fashion, too. As foreign investors increasingly migrate toward local debt, the investor base is shifting in terms of local emerging market investors, whether they're banks, pension funds, mutual funds. They're increasingly supporting external debt as well, whether it's government debt, whether it's corporate debt. And if you look at a case like China, you ask yourself, how can every China property developer be issuing money, be issuing bonds successfully the past year with all the problems in China, with all the worries we have around real estate? Well, a lot of these are local Chinese investors, and a lot of these are regional institutions supporting the Chinese, whereas maybe the US and Europeans are withdrawn altogether. So again, you sort of have emerging market support that goes from local to external. That's changing the base a lot and should provide some more safety, at least at the margin. Yet you still have, in terms of the corporate issuance in particular, remember I said the corporate is a multiple of the sovereign issuance, and the corporate issuance externally is just a small portion of what's lent and what's issued domestically, and we'll get to that in a minute. But also, since every corporate could go out and issue last year, half the issuer base was either junk rated or non-rated companies. So you ask yourself, if you're looking at the weak spot in terms of the corporate side, you expect that high yield, that is, those who have a speculative grade or those who are non-rated, those who are low credit quality, they should be at a lot more risk at a down cycle. And that was a big surprise last year because we expected maybe 5 to 10% of high yield issuers to default, and it ended up being only half that number. And not only are they poorer credit stories, but these high yield issuers have a lot of short-term maturities coming up. From this year to 2020, they have a lot of refinancing to do. So it's very, very important that this type of euphoria, this openness in conditions be maintained for their salvation. And again, finally, I just want to mention some other categories you might not have thought about. Private equity and derivatives are becoming mainstream as well. If you look at sort of the shift between stocks and bonds, that's sort of the classical trade-off. But if you're in public equity, investors increasingly are asking, well, how do I get into this private equity space, which is very specialized? And again, there was a record raised in private equity last year. There's an association here in Washington, the Emerging Markets Private Equity Association, keeping these statistics. There's about $60 billion raised. So investors want both a public and private equity exposure, and they're looking at derivatives too, whether it's offered locally on an exchange in terms of futures, options, and the like, or what we call credit default swaps, which are ways that you can either hedge against risk and hedge against sovereign and corporate risk, or decide to take a speculative bet, to go short, to go long. You have an index for credit default swaps as well. That's not very well followed by a bunch of very specialist investors. But again, average investors are starting to pay attention to that category, and they want to have some sort of exposure. Any questions before we go on to the regions? Go ahead.
I think one of the reasons that private equity is probably increasing at such a rate is that over the past 10 years, we've had an increase in the correlation between indexes like MSCI and the S&P, so it's not seen as great of a hedging diversity as it used to. So as those kind of correlations rise, would you say that's the kind of natural investor response, is to move heavily more into private equity and other alternative financing? And if that's the kind of route, how does that kind of fundamentally change how funds are operating? Are we seeing more emerging markets funds move away from public equity and into private investments, or are we just seeing more kind of value investors looking at frontier as the kind of next public equity market?
Thanks. You sort of sprung my conclusion early, but no, I'll get to it. I'll just treat it at the margins a bit. The whole story of emerging markets is obviously the risk reward, right, and the lack of correlation. Everything is correlated, everything is going up uniformly. You want to be able to change that in terms of the differentiation. At the same time, since equity is coming back at the past year, and we sort of can expect that if you're looking at the fund flows early this year. You're looking at consideration of other categories. There's a mainstreaming in terms of the technical, in terms of the comfort level of private equity, and it doesn't, the specialization, the hyper-specialization that we saw in emerging markets that's really evolved over the past 20, 30 years is really sort of coming full cycle. We're going back to sort of the generalist approach in terms of investment. One, because the indices, as you can tell by my brief conversation here, it's very complicated. It's very technical. It's hard to follow. And investors now want sort of an all-source offering. So they're looking at, even if the numbers don't add up. They want small, they want large, they want different asset class, they want different geography. They don't want to have to follow the peculiarities of weightings and indices. Any other questions? Okay. I'm just going to go over these regions very fast because obviously we can't do it exhaustively. But I just want to perhaps point out that it's a mixed bag, that there's no reason that everything should be going up uniformly because the stories are all different. And you all know this, whether you're studying that yourself or just instinctively. And in Latin America, I'll just point out some of the major warts as well as positives. Does anyone want to take a crack at what are we worried about most in Latin America this year? Elections. Elections is a big uncertainty, but yet, I mean, you can say that, you know, it can clear the way, you know, sort of for a new wave, right? Some reformist governments overcoming the scandal and the like. You mentioned Venezuela. Yeah, that's very important. Venezuela is very much underappreciated. If you're looking at it as a bond investor, that's one thing. But this is the sort of, you know, remember we mentioned the refugee flow, you know, perhaps as a global factor. Nobody's really paying much attention on the extent of the humanitarian crisis and particularly the economic spillover in Colombia, Brazil, and other neighbors. And that's a huge story too. Is there anything else in Latin America that you're particularly worried about?
What about copper? Can you sustain?
You have the commodity story, right, which is very mixed. You have these perennial scandals and the like. Is there anything else that you're concerned about in terms of the individual as well as global stories?
This is a bit more Central America, about the infrastructure redevelopment of the Caribbean islands and Central American islands after the hurricanes, and whether they're going to get the funding for that.
Yeah, I mean those are sort of classic frontier markets, and infrastructure and financing is a big question. We have this in Colombia; it's a big issue in the elections, and there are certain countries that have sort of lost their mojo a little. Argentina was a big darling story carrying through the past year, and now we realize that, you know, fiscal deficits in Latin America are still pretty serious. Inflation is higher, basically, than in most emerging markets. And then you have, obviously, you know, the risk of election cycle and humanitarian crisis. To balance, you know, what are the positives in some of these countries as well. And of course, in a place like Mexico, we're very much focused on, you know, the NAFTA future and the like. Brazil, you saw just in the past day or two, pension reform, everybody's thinking that this is a done deal, and this is a very decisive factor in Brazil's fiscal future. They've been running up a lot of public debt, and now it's sort of off the table until the elections to just add to the uncertainty. So again, a little bit of the shine coming off Brazil, which was really a bounce off the bottom in terms of recession. And any structural reform that was done, it was more structural reform that was done than was done the past decade. So again, it's sort of a more mixed view. What about in Asia? Asia, we won't go. China is its own, obviously, conference. But what any worries about the rest of Asia? We know that this is the highest growth area overall. Traditionally, you know, very high savings and investment rates. Current accounts are positive, except for India. Fiscal deficits are minor. Are there any worries? Remember we talked about the banking system. The banking system is not only vulnerable in China and India. You saw that in India, in addition to having high levels of non-performing loans and state rescues, you have massive frauds. But remember, we talked about the domestic demand, and this is where you sort of you have to weave together the story. Why is the growth rate so high? If it's not just exports, if it's coming through domestic demand, how are you stoking that domestic demand? A lot of it's coming from consumer and corporate lending. There's a lot of household and corporate debt built up in Asia, particularly in Korea, particularly in Thailand, particularly in Malaysia. You have household debt levels that are about 80% of GDP. So this has a big potential to go wrong. And so you have to pay attention, to the banking system in Asia. And obviously it's magnified in a case like China and a few others where you have all the shadow banking concern as well. Europe. Anything bothering you in Europe? Anything that's particularly favorable or upbeat? Europe has done very well, but here's where I would say that the politics, we talk about the politics sort of plateauing, but here's where you have a wave of populists. In Hungary, in Poland, very anti-immigration, very much populist fiscal monetary stimulus. The Czech Republic, you also have a business executive just elected to lead the government. So you have that story. It hasn't yet spilled over into economic policy that concerns investors, but obviously it can move in that direction. And certainly in a more unfavorable external environment, that populist policy will be that much more distinct in terms of its negative economic consequences. And the EU, the first 4 countries as well, another repercussion you have is what's also sort of a second wave effect of Brexit. We have the British no longer contributing to the EU budget, but it's very much an unknown story that a lot of the EU is still very much dependent on aid from Brussels to a huge extent of GDP, often beyond, it's often a multiple of any foreign direct or portfolio investment they're getting. So you got to pay attention to what's happening, sort of the second-hand effect of Brexit in terms of the EU bilateral aid. And Russia and Turkey have really become marginal stories. And these are the 2 places I would say that, not only you have the peculiarities of the Russian situation in terms of sanctions, Turkey, you have a lot of economic overheating, and obviously you have the post-coup environment. But in Russia and Turkey, you have slow motion, or you can argue even faster, you have actual banking crisis underway. In Russia, you've had 3 of the biggest private banks already rescued by the central bank. In Turkey, the reason they've been able to grow very well the past year, about 5% plus, is because basically the government told banks to lend. Again, get the consumer side, get the corporate side as an undergirding of domestic demand. But the banks were already in trouble before, and obviously they're going to be facing a wave of non-performing loans, and unless the government comes to the rescue itself, they're not going to be able to afford another wave of lending. So in Russia and Turkey, we're very worried about the banking system. This is all reflected in Rader's reports as well. I'll just go quickly to the 2 frontier areas, unless anyone wants to chime in. Remember we talked about Saudi Arabia sort of being, a structural reform story, whether you buy it or not. But what you got to remember about the Middle East is it starts way behind all other emerging markets in terms of the structural story. And Egypt just renounced or just abandoned its currency peg to the dollar, which is still very common in the rest of the Middle East. Well, in most emerging markets, they were forgotten during the Asian financial crisis. This is sort of the last bastion of fixed exchange rate regimes. And you can argue that in the case of Egypt, for example, unless it had an IMF program, it would still have a currency peg. So again, you're weighing this structural reform story. It's sort of a moving target, but external influence is very important. And in the case of Egypt, in the case of Morocco, in the case of Tunisia, you have IMF programs. And that's a very critical element you always have to have in evaluating emerging markets as to what the prod is really to push that structural reform story. In Saudi Arabia, you don't have that, obviously. But starting from, a policy of no privatization, very massive fiscal deficits, there's certainly a move in the right direction. But the concrete application and the real leverage to make it happen remains to be seen. And finally, just Africa, quickly. Africa probably has the highest growth rates outside Asia, at least in nominal terms. I mean, you look at a place like Cote d'Ivoire, Ghana, they're all growing, the traditional emerging market 7+% that got us excited in the early years. But obviously, there are some downsides. There are very big fiscal, current account deficits. And if you notice, with the IMF connection, it's very important too in Africa, because one thing you haven't noticed about Africa is about every oil exporter has been bailed out by the IMF the past year. They've all gone into, IMF agreements that call for a lot of structural reform, fiscal consolidation, and they've run up a lot of debt. Because remember, we said with the easy access, frontier issuers can get that money too. So a lot of African countries that already went through this cycle a decade ago and had to get official debt forgiveness, they've been able to borrow commercially very easily, but now they too are running very high debt to GDP ratios at the 50+% range, requiring an IMF rescue. So obviously that's a consideration to watch. And you look at a place like South Africa, you've been looking at the headlines. South Africa, what you learn too, is not only one of the cases where they had to defend, the exchange rate, where they had to raise interest rates, but South Africa, because it is such a sophisticated financial market on the continent of Africa, it's sort of seen as a proxy for all of Africa, but a proxy for all emerging markets too. So there's a lot of rand traded both as a currency and as a local debt play that sort of is a reflection of risk appetite in emerging markets generally as well. Anything anybody want to add, or go ahead?
Quick question about
Sure,
Africa.
sure.
Who are the primary creditors in the African market other than China?
Well, what's very different now is that you have, and here in a case like China, you can argue that it's both official and commercial debt. But since Ghana was the first to go to market about a decade ago, every African market has been able to issue external commercial bonds, Euro bonds, global bonds, almost regardless of the credit rating, and pan-continentally. And you have foreign investors. Remember, we said foreign investors have very big positions in local debt. Well, foreign investors have come in places like Nigeria and bought up a lot of debt too, so that they're the biggest investors. So again, Africa has entered the mainstream, but obviously it's a double-edged sword if they don't have the other policies in place and can't afford it going forward. And thus the IMF had to come to the rescue, even for big oil exporters in West Africa, like Cameroon and Gabon. They're all under IMF programs now. Kenya, Ghana, Zambia is entering one. So what do we say in conclusion? Obviously, you can sort of read between the lines that the continuing message has been there's a distinction between the leaders and laggards that we should expect and what was avoided last year under a confluence of very unusual circumstances. But we should see a lot more differentiation this year. We're not going to see 35% gains. We'll be lucky if we see maybe high single digit, low double digit. We'll see a lot of losers as well as winners. And that's positive overall, because there should be a lack of correlation. There should be a differentiation. And if you look at the overall wave, remember I said at the beginning, we're starting to look at emerging markets as a pull influence. Well, investors really weren't looking under the hood. Now they're starting to. And you see the distinction already in January, February. You see that there have not been inflows as heavily, and you see that there are some losers on markets, regardless of the asset class, both in terms of bond and equity. So again, we'll see a much more mixed picture. And we're not only looking at sort of the short-term policies in terms of growth, fiscal, monetary. We're looking at what's the model change going forward in the medium term. Remember, we talked about moving to domestic demand, but how can you support this sort of over time? The export-led model, had been really the driver for emerging markets all these years. And we're sort of revisiting, well, what do we do about, education and health, and how do we raise, our productivity? And how do we, in terms of the financial sector, a lot of the reforms, have stopped, or have been very marginal for the past 10 to 20 years. You had an initial wave in the 90s where you opened up, there was a lot of excitement, a lot of change, a lot of foreign investors going in, a lot of privatization. We haven't really seen that. The financial sector is ripe for a lot of dramatic change, particularly, as we mentioned, because the banking sector is very vulnerable. Of the trillions and trillions of dollars in debt outstanding, particularly corporate debt, 90% of it is just local bank borrowing, is just typical facilities, corporate facilities, whether they're for working capital or for longer term infrastructure purposes. But if you look at any measure of banking conditions, the Institute for International Finance has a lending conditions survey where 50 is sort of neutral. It's been below 50 for the past 2 years. Non-performing loans are rising in almost every banking system that you can cover. Also, you look at some of these other indicators of bank health, whether it's capital, whether it's liquidity. And remember, we have the underlying disparity of credit growth outstripping GDP growth by 2 to 3 times. That's unsustainable, that never lasts, that's always a recipe for underlying crisis. So this year, when investors are making that distinction, they're going to start paying a lot of attention to how the banking system is really doing, what's the vulnerability in terms of local debt, what's the strategy in terms of rescue. You still have very heavy state bank ownership, and it will be up to the government to rescue these institutions if there's trouble, if they don't go to the IMF. And remember, we said that fiscal deficits have run up during the crisis, so there might not be a lot of space for rescue. And if you look at the magnitude of the debt, emerging markets overall, it started with debt to GDP ratios at the beginning of the crisis at about 100 to 150%. This includes all forms of debt, local, external, sovereign, corporate. It's basically risen another 50% over the past decade, and the vast majority of that is local bank borrowing. So pay attention to the banking sector this year as a major differentiator. And the integrated strategies I want to get to, we talked about this a little bit. Again, in terms of the investor sentiment and preference, because stock markets have sort of come back front and center, there's a search now for a sort of holistic, integrated approach. And this should also animate your thinking when you think of becoming an analyst or joining an institution, to think more in sort of generalist terms, that I might have I might be a Latin studies specialist, but I should think of other geographies. I might like stock markets, but I should learn a little bit about how these other markets operate, because that's increasingly where investor demand is concentrated now. They're looking across different geographies. They don't want to just follow weightings and indices. Remember, I said, for example, China could be half of the stock market index. Well, they don't just want to be in China because it's in that index. They want to be in a lot of different countries, small and large. They want to be in a lot of different asset classes, and they want to be in a lot of different size exposures as well, whether they're companies, whether they're countries. And so we see that sort of over the next few years, you'll see a lot of these indices that we talked about. They'll start to consolidate, or they'll become hybrids, or investors will start to ignore them altogether, as they did in the early days of emerging markets before we had these indices, and just sort of focus on what's the return I'm getting. If I'm getting a 35% return in my stock market last year, if I get a 30% return in sort of a mixed strategy, that's still pretty good in terms of global investment going forward. And we really have the potential, should all these processes really align and evolve reasonably as we expect, that you could really have a third golden age of emerging market investment toward the end of this decade. The first golden age was when emerging markets first opened in the 90s. Then we had a boom from 2000 till the crisis. And basically, we could revisit another very upbeat cycle on which I hope you'll be very well positioned with help from me and others. And I hope we can all enjoy that ride together. And I look forward to your questions. I'll sit for my questions. Sure, go ahead. If you don't mind introducing yourself too. And
I'm Christian Conroy, to a degree MSFS as well as Master in Public Policy at Geopolitics. And speaking of policy, you touched a little bit upon SOEs in the conversation a lot of these markets. And so I'm kind of curious, especially with the IMF having such a strong role in many of these countries and the kind of neoliberal policy suggestions they might put forth. Do you see kind of the privatization of SOEs as a positive goal in terms of returns an investor could get? Thailand right now is going on big SOE reform ahead of its elections. You have Indonesia making half their GDP on SOEs, but still having a very positive return. So is that kind of an absolute goal you think that as someone investing in these markets, you should hope for SOE reform? Or is there kind of pitfalls to that that can actually do the opposite?
yeah, this is what we talk about when rediscovering that structural story. Because really it's been, suspended for the past decade plus, really before this global financial crisis, really going back to the Asian financial crisis. Privatization was sort of the watchword, deregulation, liberalization, foreign investor opening. The difficulty in emerging markets now is the IMF was such a big influence. There was so-called, the Washington consensus, where you just sort of follow a recipe, and investors were sort of aware of that. And you had the thumb of the IMF and other lenders able to achieve those type of reforms. Well, now this is all predominantly, particularly in Asia, where you mentioned, it's all going to be sort of self-driven. And I don't think it's going to happen just because you have very bright officials, you have private sector participants that know this is the way to go. They probably will have to be driven by some sort of other factor, mainly an emergency of sorts. And I think in Asia, what's going to change in terms of the state enterprise sector is, should markets come off a little bit, they're looking for sort of a good news story, adding some additional issuance and excitement. But I think you got to look at the banks in particular, in a place like Thailand or in a place like Indonesia, not as much in Indonesia, but they're indebted a lot to state companies. And they have a lot of household debt outstanding not because someone wants to go buy a washing machine necessarily, but because there's a stimulus policy blessed by the government that says lend to consumers without necessarily saying that we're going to backstop your losses, but that's probably the eventuality. So I think looking at that weakness, I think that's what's going to drive it as much as sort of the favorable, positive outlook for privatization. But that being said, privatization has really come back sort of as a watchword going forward. We want to see another wave of that. Rosie. Well, on the crypto, obviously, this is an issue that everybody's sort of grappling with, but emerging markets have really seen sort of the downside of it pretty dramatically. I won't talk about, in Korea, there have been a number of frauds. There also have been, in terms of, cryptocurrency incursions, whether it's in the Eastern Europe or elsewhere, there's been a lot of, embezzlement of cryptocurrencies, and the central banks are very wary of this as sort of an attack on their banking system, much more generally. So, the blockchain, the technology, the alternative currency or monetary policy aspect aside, I think a lot of regulators in particular are grappling with the sort of the anti-fraud imperative right now. The IMF, and we'll talk about this, in the workshop, the role of the IMF has obviously, changed a lot. But they do have a very important role still in a lot of frontier markets. I might not only mention Africa, but I mean, there were a lot of other rescues last year in Mongolia or elsewhere where you would have had, basically runs and defaults, had the IMF not been there. That being said, we talked about the architectural redesign, and there are a lot of other institutions potentially able to play at least, the liquidity or financial resources role, whether it's in terms of infrastructure or whether it's in terms of eventual rescue. Remember, the BRICS have sort of, set up their own facility, $100 billion they allegedly have on hand to help each other out or anybody who would come to them with a balance of payments run. We know in Asia we've had this Chiang Mai relationship built up, since the Asian financial crisis that has since been reinforced several times and was tested actually with Indonesia, at least marginally, several years ago, and it was helpful. So you have all these other institutions forming. I think what we have to look to the IMF for as well, and I'm leaving aside all the debates about, voice and shareholding, is the quality analysis and sort of the technical input. And what I would like to reinforce is you can't go to any other institution and sort of download quality information about what's going on in every country, whether they're under a program or not, and whether it's macro or micro. Sure, you can go and you can see what their projects are doing, what their pipeline is, what issues they're working on. They might have some general publications, but I mean a new institution, like the AIIB, or the existing institutions, the regional institutions that exist, whether they're Asia, African Development Bank, they do not have the gravitas that the IMF analysis has in terms of the surveillance capability and in terms of the intellectual input. And so I think that's where the IMF's real strength still lies. The question is, it's a public good of sorts. Eventually somebody has to pay for it, and eventually somebody will compete with it. I certainly would keep my eye on some of these other institutions, seeing some scope in that space. And there have been some. I know the EBRD, they do sort of their own flagship publication on structural reforms in particular, and capital market development. They look across the board, which is really a very deep insight, more than sort of the IMF has on a standing basis. And a lot of them have looked at sort of, you have the ratings agencies and you have sort of the IMF surveillance. Is there something I can do as an institution in between and sort of provide public ratings of, economic and financial sector policy making and performance? So you have institutions sort of grappling for this role, because what's interesting now is, whether you see it at the World Bank or otherwise, there's this competition for justify your existence, reinvent yourself, transfer the billions to trillions. But for that, you have to have sort of the private sector relevance and resonance. And so you have to provide, a new level of quality work. Sure. Go, let your friend go.
Hi, my name is Jan. I'm studying technology and international development as an undergrad. And I had a question actually on this last slide. So you ended saying that there's going to be a potential golden age in 2020, but I'm unsure about your previous point then that credit growth outpacing GDP growth is a recipe for crisis. So would you mind clarifying that dynamic?
Well, I think we'll see some of these crises coming to a head. Remember, I mentioned, in Russia, Turkey, some other places where it's pretty obvious and looming. right now. And I think this is what investors, this will be in the hierarchy of decision-making factors when you're looking in terms of economic and financial sector policy, that banking health and oversight will be a primary consideration. And so I expect that to sort of work itself out over the past 2 to 3 years. But getting to your colleague's point, I think that's also, a right platform for privatization, because state banks they've remained for decades, and state ownership in other parts of the financial sector, in pension funds and mutual funds, is still very, very heavy. So it's a recipe in terms of resolving the crisis, generating the resources and efficiency, to really moving privatization ahead in that sector too. Sure.
Hi, Jordan DeGroat, sophomore in the School of Foreign Service, studying regional comparative studies, looking at Eastern Europe. I apologize for the many questions, but you really got me hooked. So. You mentioned the investment, the attraction of credit default swaps and derivative investments, even for retail investors. I assume that's probably also going along with the renewed increase in CDO investments. And my question is, to what extent do you think that the investments in emerging markets are leveraged and potentially over-leveraged, and what is the level of exposure for something like the S&P 500 to these emerging markets?
Well, leverage, when we talk about the credit growth, that's all a leverage story. Household corporate indebtedness and banking system vulnerability, that's all a leverage story. You see, the headline in China is all about deleveraging, because China is probably the most extreme example of outsized credit growth, not only coming from state banks, but also coming through shadow banks where they have no idea what the channels are. So deleveraging is an ongoing phenomenon that's going to help in terms of the macro side too. The CDS, credit default swaps, I don't think a lot of retail investors are in it yet. They're starting to ask about it, and certainly because there's such a mania for emerging market assets generally, the broker or the investment house certainly said, have you heard of this? But I don't think there's not sort of the multi-layer leverage that we saw with the CDOs. That never really happened in emerging markets because the markets don't have the sophisticated platform available that we had in this country in terms of the technology. What's interesting in emerging markets is that when we talk about capital market development, it's sort of been stunted, since the early days of the IMF programs, the openings. You started stock markets, you started bond markets. Nobody really went into derivatives outside a few countries like Brazil, South Korea. So you have a lot of opportunity to develop just normal sort of futures, options, and they can be speculative or they can be stabilizing, but it's sort of an expected part of the emerging securities market menu that investors anticipate going forward.